Hi, this is Joe. We're going to talk about the S&P 500 today. There's really four different categories when I'm looking at the market condition and how the market is situated right now. The first would be trend, and probably the most important. The second has to do with volatility. Third would be an overbought, oversold condition. And then the fourth is sentiment. I'm going to touch on all of these, but for the most part, I'm going to focus just on trend, volatility, and the sentiment. So let's get into the charts. Always look at 4 time frames when I'm analyzing the trend. I'm trying to identify, does the market have a real power condition in place based on the trend? And we always start with the higher time frame. I've got the monthly chart here in the bottom left. And I use an 18 and a 40 just to review. I use that for every single time frame. When I look at the monthly chart, the 18 is above the 40 and both lines are rising, and that condition has been in place for the most part really for this whole bull market. The 18-month went flat during 2016, but other than that, the short period, there's really been a pretty strong condition in place on the monthly chart. That doesn't mean that it's always been a buy. I mean, you're always looking for where support and resistance is and whether you're overbought or oversold. And right now, so if you go back and look at this period here where we undercut the low from 2018 and then reversed, we were in an oversold condition, finding support from the 2015-2016 area and, deeply oversold, and we got a really good rally. Right now, I don't know that I guess I'd have to call, if I'm looking at a monthly chart, I'd probably call it overbought. It's getting a little overbought, and you're coming into this resistance zone. If we switch over the weekly chart, I'm going to zoom in a little bit. We're still fighting the same area at 3,200. And if you notice, we've been talking about this for several weeks. It keeps bumping its head on it, and it can't seem to get through there. It's sort of a little bit of a struggle. So again, if I'm looking at, let's just use the 18 in any time frame, and if I were to go through and look at it on a monthly chart, it's above a rising. The weekly chart is above a rising 18, which is right here. This moving average, that's the 18-week moving average, and you can notice really since July started, this moving average started to turn up and rise. So it should provide support on a pullback. What bothers me about it a little bit is that there is a lot of air between, so it's at 2907 is where the 18-week is, and price is way up here at 3215. So we've got a little bit of the possibility of more sideways action while this moving average tries to catch up and move higher. But I do think the fact that this moving average is rising now, it does provide a support, some support on any kind of a decline in the near term. That's assuming that we can't get through the 3215 level. Let's go and look at the daily chart, and I'm actually going to switch and show you something. So I've shown this chart several times over the last few months. What I like about it is it gives all 3 time frames. It's a daily chart, but I've got all 3 time frame moving averages. I've got the daily line here is the magenta colored is the daily 18. The red line is the monthly 18, and then this blue line, which was declining and is now turning higher, is the 18-month and the 18-week moving average, which is the one we talked about on the weekly chart. So I guess the reason why I like to see this is because we've got all 3 trends basically on one time frame. And so mostly when I bring this chart up, I really just focus on these moving averages, but there is another component to this chart, and if you look at the bottom half of the scale, it's really this blue line is what it is the S&P 500 daily chart with the average true range is the blue line. Going back, I'm using a 20-period moving average of the average true range. And average true range is pretty simple. If instead of using the actual bar, so let me zoom in a little bit so you can understand this. Instead of using, let me go back so you can see. So if you look at this candlestick, if you use just the low of the bar to the high of the bar, you're not really getting a full idea of the true range of the day because it had a gap. So what true range does, if you're going to use average true range as a calculation, it's taking this whole part from the gap all the way up to the top, and that's considered the range for the day. So if I were to draw this up, I would say, you know, that is really what the range was for the day on that bar. So anyway, we're taking a 20 period moving average of this average true range. And what that does, as we go through and look, you know, it tells you, it's giving you a measure of the size of these bars, and it's really a measure of volatility. If we go back, and I know if you go back to some older videos, you can see that I talk about some of these trades that we did right as the bear market started. I'm just going to give a quick review and show. So if you look at what was taking place with the ATR, it was declining through late last year, and then it finally got it rallied it up early in the year to break the trend line and then start to get the moving average to turn around. And right about here, my partner and I put some puts on and to protect the market, protect our holdings, our long exposure. It was done more as a hedge, and most of the time when we're putting puts on, we're really doing it more as a hedge, as opposed to really trying to make a huge amount of money to the downside. But I'm hoping you can see the fact that once the volatility started to kick in, to us it raised a pretty big alarm as that component of market condition started to increase in risk. And then if you notice, so we took this trade, we ended up losing money in these, even though it did make a decent move to the downside. They came back a little quicker than, you know, maybe we would have liked to have seen if we were trying to make money to the downside. But what happened was the same setup showed up again right here. And literally within hours of the high, maybe within, you know, maybe the second day of the high, we essentially put on some puts and made some serious money on those and did a really good job of hedging our long positions through this decline. And then I put in the arrows as to where we did additional. So most of the time when we do puts, we're just taking profits as they drop down, but we ended up putting them back on in these other spots where I have arrows. So I'm trying to point this out because I wanted to go back through that historically speaking to show that right now we don't have that same situation in place. We really don't have this blue line or the ATR for the S&P really starting to turn up and pull back to its moving average yet. That to me is where the risk starts to dramatically increase for this market right now. And if you notice, if you just looked at the price bars, you can see they're just not big enough. There's not enough continuous big volatility over a 20-day period to get this blue line to really get going to the upside. You know, one day isn't going to cut it. That was one huge day to the downside, but then right after that, they kind of started dropping down, and the size of the bars started dropping. So we need some volatility to grow and kind of stay a little bit on the bigger side if we're going to see. I think if we're going to see the risk of the market really increase dramatically. Before I go into the last component, which is the sentiment numbers, let me just make a quick note. Hit the subscribe button, and when you do, make sure you hit the alarm so that you get notifications. And then, in fact, I'm going to go take a quick look at the hourly. We've been talking about this for a long time. The trend line was broken. We've been sort of testing, but we haven't taken out the lower horizontal line, which would signify a shift in the trend to the downside. And instead, what we've been doing is sort of banging our heads up against the upper horizontal line. And if we break through that, I think that really increases the odds that we're going to go testing the high up around 3,400. Now, I want to look at sentiment, but because I think if you look at what's taking place here and the fact that we break out, the reason why I'm seriously questioning it going dramatically through 3,400 is because the sentiment numbers have gotten to a point that I would think is a little bit more on the dangerous side. So, this sentiment, this is the investors' intelligence, bulls minus the bears. It's the letter writers. I've been using this specific indicator for almost 30 years. It is a very powerful tool. And if you notice in the two drops in the two bear markets, both in late 2018 and earlier this year, the number of bears exceeded the bulls, and that caused this black line to drop down under zero 2 different times. So, or I should say in both cases, it dropped down under zero. And that provided a pretty good backdrop for the strong rally that we've got. And it's really the reason why when the market undercut the low from 2018, I started feeling a little bit more bullish as price action started to show up and improved as the market turned around. Now, what's taking place now is the sentiment number has actually reached the 40% level. And once you get to 40, it's definitely a time to get a little bit more on the defensive, a little bit more cautious. It doesn't necessarily mean the market's going to get a big drop, but you're increasing the odds that we're going to go through some kind of a pullback, or have some, at least I think you have some increased risk. Now, based on the fact that the current trend for the market is showing a price above all the key moving averages. So if I go and look at the trend, the trend is still okay, and trend, it supersedes anything else. If the trend is strong and positive, you always go with the price action ahead of the sentiment numbers. But because the sentiment numbers have gotten up into a range, and we have a little bit more room, I mean, even getting into the low 40s, mid 40s, I mean, it's certainly a possibility. It's not necessarily going to hit 40 on the nose and turn on a dime. And it's really not a timing indicator. We use price to kind of time things, and we use the sentiment numbers to tell us, it gives us a backdrop that says, you know what, right now the risk in the market has increased somewhat, and we've probably got a little bit more of an issue overhead at resistance up here at 3,400, 3,350 than maybe we would have if the sentiment numbers were better. So because the sentiment numbers aren't that great, or they're starting to show that people are getting a little bit too bullish, I would start to be a little bit more cautious about my entry points. Maybe look for pullbacks and be a little bit more judicious about where I want to do some buying. So anyway, hit the like button, and we'll talk to you soon.